We're live at the CAIS Summit here in beautiful Beverly Hills, California. And we have with us Rob Collins, who's a partner at the Partners Group.
That's right, Chuck. Great to be here. Great to be with you, and great to be joining from this wonderful, independent-focused conference.
Absolutely, and I appreciate you taking some time here. So I was really looking forward to this. So I understand that the Partners Group was the first firm to put out an Evergreen alt fund. Is that correct?
That's correct. We have a long history of innovation. I like to say we're the quiet force in private markets. So we've been doing evergreens for about 2 decades. And here in the States, we created the first purpose-built solution for the wealth market, and specifically for an RIA in 2007 who said, Rob, why hasn't your community of private equity managers, private markets managers thought about us as advisors, independent advisors to families? Yeah. And I said, great question. We are thinking about you, and we care about you, and we understand your pain points. So we really took that to heart. That's very much part of the Partners Group DNA. We do listen to clients. We love developing solutions, and that culminated in the launch 2009 of Partners Group Private Equity Master Fund, which is regarded as really the first true, purpose-built, evergreen private equity fund for the U.S. market.
Sounds good. So there's a lot to unpack just right there. So maybe let's kind of get Evergreen Funds 101 first. Like, what exactly is an Evergreen Fund? You guys were the first, and we'll talk about where it's gone from 2009 to where we are here at the CAIS conference. So what is an Evergreen Fund exactly?
Sure. If you think about the private markets industry, decades ago really built for the institutional investor. So for large foundations, endowments, public plans, corporate pension plans. And the vehicle that was used, the product, if you will, was a limited partnership. It goes by many names, a drawdown fund, a capital call vehicle, but in essence a 10-year limited partnership where the private equity managers are the general partners and the investors are the limited partners. These are not investment vehicles, they are commitment vehicles. So for those
That's a good way
of you,
to put it.
yeah, so you commit to send a capital call or fund a capital call when that general partner finds an investment. And this is where the notorious J curve comes from, but really different if you think about comparing that to a mutual fund, for example, which is an investment vehicle. You decide how much you want to invest, and at the time you want to make that investment. So what we've done, and the way to think about these evergreen funds, is to really make them look and feel and resemble that traditional experience that an investor would have using an investment vehicle like a mutual fund. In some ways they are mutual funds. So Evergreen 101 is a fully invested vehicle that's offered perpetually, typically at much lower minimums than a traditional limited partnership, with typically, not all of them, but typically with 1099, not K1. So really solving for those pain points in terms of regulatory eligibility, minimum bite size, performance reporting, tax reporting, but most importantly, you're getting invested and you're staying invested. So that's Evergreen 101 to us. We also think Evergreen 101 is regulated. So ours is a 40 Act fund. We have an independent board of directors. We have transparency. We say the most regulated private fund in the known universe. So that's Evergreen, and it's really been catching fire in the last few years in a very positive sense, because we proved that you can have simplicity with an outcome that's as good, if not better, than the traditional drawdown fund.
Right, and they're talking about the democratization of alts, and I think these Evergreen funds are really leading the charge on that.
Correct.
So here's a question I have. So you have Evergreen, but you also have private investments, right? So I can't go ahead and sell a piece of a company that I own privately. So how does that liquidity work in an Evergreen fund?
Great question, and you're making me think of really the big picture. So maybe start with the big picture.
Sure.
Is the shift from public to private. And that's why this is an important conversation. And I've been asked the last couple of years, why is this democratization theme so prevalent? Why are people talking about these funds? And that's because the economy continues to shift public to private. And I'm sure many of the viewers of this have seen some of the statistics. The number of public companies has declined by half in the last 20 years. The Wilshire 5000 only has 3,000 companies in it. 87% of 100 million revenue companies and above are private, not public. So this
I didn't know that. Let's do that stat one more time, because I think that's an important stat. Give that to me one more time.
87% of 100 million revenue, so again, real companies, sizable companies, are private, not public. And so the reason why this is an important conversation is because we all believe in having this ownership society. And decades ago, the innovation of mutual funds really helped foster that ownership society. But now, because many of the best companies have been staying in the private sphere, they haven't been going public, we need to find a way to foster that ownership society, foster that democratization, if you will. So that's why these evergreen funds are really effective, because they help in that access. They help solve the big challenge, which is how do we foster that ownership and enable people to have full access to the economy.
Got it. So there's always been access, but that access was really limited to a small portion of the population, the endowments, the uber net worths, and all that kind of stuff.
Correct. You either had to be super wealthy or have a defined benefit plan. As we all know, that's been going away for decades. So this is why you've actually had the regulatory environment be supportive. This is why you've had the SEC support these evergreen funds, why you've had the DOL provide guidance for pension plan sponsors in the 401k market to incorporate private markets. And this is why it's an important conversation.
Right. And also, so at my shop, this is sort of my side gig. So I founded and run Sovereign Financial Group. We're $1 billion RIA shop. So we love talking this type of stuff. And we are actually in the process right now ourselves of launching our own 40 Act fund, which will essentially be a fund of funds.
Yep.
So one of the reasons why I like to doing these on locations for Investment News is they're sort of picking up the tab as I'm doing due diligence for my firm. So it's a
Very
win for everyone.
efficient use of your time, Chuck.
It certainly is.
Yeah.
So I could see the private credit, right? It has some income coming through, but how do you get liquidity in a private equity situation?
Thank you for reminding me. I didn't answer your question from a minute ago. So you have to have the right capabilities. I say the starting point, private equity, right? Private equity is mostly, if you just look at the composition of the activity, it's mostly buyouts. So control buyouts, that's where we focus. Mid-sized companies that have 50 million to 250 million of cash flow. Again, real companies, operating companies, profitable companies, some of the best companies. 3/4 of our companies are 1, 2, or 3 market share businesses in their respective industries. And we're buying them, we're helping them grow. And that's really the underlying force of this economy moving to private, is that the entrepreneurs, the management teams just feel like they can best execute their mission privately. Okay, so we're helping them execute that mission. We typically own those companies for 4, 5, 6 years. So on the liquidity side, think about that. If you're building a portfolio, if you have a mature portfolio, typically hold 4, 5, 6 years. That means you have about 20% liquidity coming back to you. The companies that we bought 4 or 5 years ago, we're selling now. We sold one last week, for example. We have one going public right now this week. We had one that went public earlier this week. So if you build up this portfolio over time, you can build this inherent liquidity profile. And then there are things that you can do to further augment that liquidity. For example, you mentioned private credit. So we buy companies. We also have a private credit business. We do a lot of things at Partners Group. We also do private equity secondaries. We do select fund commitments. So we have this broad engine that enables us to get invested, be diversified, and then provide this liquidity over time. Now, importantly, one thing I haven't mentioned is that these evergreen vehicles aren't liquid. They are not liquid alternatives. So ours is specifically a tender offer fund. So you can buy units on a monthly basis, and then we have a quarterly tender. And when we started the fund, we said we intend to provide a 5% tender every single quarter. By the way, we've made that offer every single quarter since we started the fund in 2009. And we felt like that was something we could deliver because, again, we built this portfolio. We have this capability to, again, build this consistent liquidity profile so that we can meet that 5% tender should we need to. By the way, and the ultimate complement, people tend to stay in our fund. So we've offered 5% every quarter, and only 1.15 or so is what gets transacted. We've never gotten above 4. That was, our peak was 10 years ago, 3.5. So very sticky, investor base, because again, I think we're tapping into this real need out there for this efficient, effective solution to give access to these wonderful private companies that you can't find in the public markets.
I love all of that, and that's a really helpful explanation. I'm almost thinking in terms like a laddered bond portfolio is sort of what you're describing, right?
Yep.
So they're kind of aging out, they're maturing, if you will, kind of like a bond would mature.
Yep.
Except in this case, you're selling them or IPOing them, and then that creates some potential liquidity.
Yep.
The last thing I want to touch upon, and I kind of want to talk about secondaries, but we have Dave Donahue coming up in a little bit from
Great
Franklin.
guy, love Dave.
And we're going to talk about secondaries with him, so we'll save that for about another hour from now. But I do want to talk about this idea of how democratized is too democratized. And let me give you an example on this. Did you ever see the movie Harold and Kumar?
Not in its entirety, but I'm familiar.
You know what I'm talking about?
Yes, know what you're talking about.
Do you know why I'm bringing this up?
I do not.
Okay. So the guy that played Kumar, I think, right? And for those of you that don't know, Harold and Kumar was this kind of adventure of a couple of pot-smoking guys go around the country. He was the spokesperson for Yield Street in an advertising campaign. Is that showing too much democratization?
Great question. We put out a white paper a couple of months ago about the Evergreen frenzy, because it is a frenzy in the last couple of years. And we kept getting asked, okay, you guys started this 15 years ago, but it's really taken off in the last few years. What do you think about it? So we put out a paper really highlighting the 5 things. This would be great for your diligence process, Chuck.
Yes.
The 5 things that you need to consider when you evaluate an evergreen fund. So does that manager have the right investment engine to deliver on all of the things that we've talked about? Diversification, getting invested. Do they have the right approach to growth? Because the temptation can be, because there's so much excitement, to grow as quickly as you can, to raise as much money as you can. That is really dangerous. So you have to have this steady growth. Again, think about our discussion on liquidity. You have to build these portfolios up over time. So does the manager have the right investment capabilities? Do they have the right approach to growing the business? Do they have the right operational infrastructure covering topics like valuation, really important topic? So that's, these funds are incredibly complicated to do and to do correctly. And so it does take some diligence, and because it's a growing sector, there's quite a bit of heterogeneity out there, right? There are interval funds, there's tender offer funds, there's multiple types of REITs and multiple types of BDCs, so it is confusing. So we're trying to help provide some education given our experience and perspective to answer some of these questions. And so you have to be careful, because when you're in a bullish type of environment, sometimes there's some managers that are able to build a business, even though maybe their forte lies somewhere else and not running an evergreen fund.
Right. And one thing I'll add to this, and we'll probably wrap it up with this, is I think it's incumbent upon the advisor to educate the client that this is not a mutual fund. This is not an ETF. This is not to get in and out of. I think it's a great investment. We are really committed to bringing this to our clients through this fund that we're going to launch. But we're going to also be very committed that this is 5-10 year money. There is quarterly liquidity, best efforts, but not guaranteed. So this is money I think you want to put aside, watch it grow, enjoy it grow, reinvest those dividends to the extent you can. But it's not a daily trade type of situation.
I'm so happy you say that. If you were to look at our marketing materials, we don't even talk about liquidity as one of the attributes of these funds. And we encourage people to do exactly what you just said, which is to take that long-term time horizon. Look at this as a 7, 10, 15-year investment. What it's really about is getting invested, staying invested. It's really the basics. And I think that's another thing that RIAs, advisors should think about. Think about best practice for your public equity portfolio. What is that? That is time in the market. That is holding your clients' hands when maybe markets are down and saying, stay with it, get invested, stay invested, compound, compound, compound. That's what's really important here, and that's what we like to emphasize with these funds. So I love how you put that. And then the other thing I would just maybe conclude with is, yes, lots of education, and that's where I'm really proud about the industry and our colleagues, our peers in the industry, really making significant investments into education. We do things like academies, for example, a partners group. We bring in advisors into our office and just spend time and answer the questions, the easy questions, the tough questions, really just provide that transparency. So it's great that the industry is doing that. Here at CAIS is a wonderful example of the work that they do, research and education to really make sure that advisors and clients are making the right decisions.
All right, that's a great place to wrap it up for this segment. Rob Collins from Partners Group, thanks a lot for joining us.
Thanks, Chuck.
Okay, and stay tuned. We have a couple more segments to go. The next one, as I kind of alluded to, is going to be with Dave Donahue from Franklin, and we're going to talk about something which I think is really interesting, the secondaries opportunities out there in private equity. So stay with us. We'll be back in about an hour and a half with that next segment. Thanks, and Rob, thanks again.
Thanks, Chuck.
Okay.